Hi, and welcome back to another episode of the Mortgage Musketeer, where today we're going to be talking about debt to income ratio. What is it? How is it calculated? What are we looking for? Intro. All right, so what is debt to income ratio? A lot of times you'll hear it called DTI, but people throw that out, oh, your DTI is too high, or it's this or that, or it applies to this loan program or the other, and then your top or your bottom or your front or your back, your debt to income ratio, blah, 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 all these acronyms. It's easier if we just go visual. All right, so let's take a look at the screen, and I'm going to actually build it for you so you can have a good sense of what are we looking at, how is it built, and what does it mean. Alrighty, so for this tutorial, what I'm going to do is focus on an FHA loan, just because it has more items, more components to it, so I can show you visually. So we're going to build this really quick, and I'm going to start off with an interest rate of 4.5%, which means absolutely nothing. I pulled it out of thin air, but it gives us the ability to do some math. Then the loan term is going to be 30 years, so 30 times 12 is 360. There we go. Now the appraised value, we're going to say the appraised value and the sales price are going to be $150,000. And then on an FHA loan, the minimum down payment is 3.5%. And the reason that we do that is because we want to know what the down payment is right here, and we want to know what the loan amount is. The system that I have auto-generates some numbers in here. So this, I'm actually going to say, is going to be somewhere around, we're going to use $100 for ease of numbers. And then property taxes, I'm going to plug in, this is for Louisville at 0.98. I'm going to use, say, 1.1 because it's often higher in different places. So that just gives us a round number to start with. Again, these numbers are arbitrary. The idea is that we're establishing some type of debt to income ratio. Now you'll see here as well that we have a loan to value, and all the loan to value is what is a loan compared to the sales price. And because we're putting 3.5% down, it's a loan to value of 96.5%. Not the purpose of this video, don't worry about it. We're going to be talking about debt to income ratio, and that's these two boxes, your top and your bottom. All right, so what we're looking at here is trying to figure out what is it going to be once we get some income in here. So we're going to, for this example, we're going to start out and say somebody makes $15 an hour. So if somebody makes $15 an hour, I'm going to say 15, and we're going to say 40 hours a week, so that's times 40, and then they're going to do that 52 weeks a year times 52, so it's going to be $31,200 a year divided by 12, so it's going to give you $2,600 a month. Now look what happens as soon as I plug this in and click away from it. Look over here. Boom. It gives us a debt to income ratio. Right now, our top and our bottom are the same. Now you hear this called a front and back or top and bottom. And what does that really mean? What that means is that based off of 4.5% for an appraised value or sales price of $150,000, putting 3.5% down, leaving a loan amount of $144,750, it's going to give us your debt to income ratio. And all that really is when we add all this up, we come down here and say it's the principal and interest on this is $746.26 a month. Homeowners insurance for it is $100 a month. Property taxes are $137.50, and mortgage insurance is $101.78. This is good on an FHA loan to take a look at. When you do an FHA loan, there's an upfront mortgage insurance premium of 1.75%. Let me get this into your screen. There is an upfront mortgage insurance premium of 1.75%. And what they do is they take that and they add it in here, and that's why it's showing that your total loan amount is going to be $147,283, because they're going to take this amount and roll it into the loan. So when they actually do the principal and interest, it's going to be based off of this. This is your total loan amount. And that's because they have the upfront mortgage insurance premium. An FHA loan, if you're only putting 3.5% down, has PMI of 0.85 a month. That 0.85 a month comes out to 101.78. Okay, so when you add all of this together, that's your total monthly payment. So it's principal and interest, shows as a first mortgage, homeowners insurance, taxes, which are property taxes, and your mortgage insurance, which is your PMI. So total monthly payment of $1,085.54. Easy math. And if I take this number and divide it by this number, then I get this for your debt to income ratio. But this is just the top. This is only your house payment. Now, let's say when we pulled in credit, here it'll populate your debts. So let's say that you've got a $500 car payment. Well, now your front end is a 41% and your back end, or your top and bottom, your top is a 41.752 and your bottom is a 60.982. You don't qualify. And this is where I get on really frustrated. You don't know how many times I pull credit, and the first thing people do when they're making decent money is they go out and they get a monster car and they're paying $5,000. And this is light. I'll tell you what, this is what I'm seeing recently as far as car payments. That's a mortgage payment. You know, if you had a $100,000 home, we can change the numbers real quick. On a $100,000 home with 3.5% down, I mean, look, $757. People are making a mortgage payment for their car. I see it almost every day. It's so frustrating. So if you're watching this video and you're thinking about purchasing a home in the future, but you really want that car, buy the home first, because we need to deal with your debt to income ratio. Because I removed this and I got a shot. Right? Now this is still high. So making $15 an hour on a $150,000 home doesn't necessarily make sense. Right? So depending on what the debt is, let's say that you had, you know, a decent car payment of $350, and you've got some credit card bills of say $75. I'm pulling these numbers out of nowhere. And you've got, goodness, I don't know, let's say you bought your fiance a ring and you're paying $150 a month on it. All right, so now we've got total debt of $575, but I'm still too high. So really what that means is that I'm not going to be able to buy a $150,000 house if I'm making $15 an hour. So you only have two choices here. I need a new job. So let's say I go out and I've been working, studying, or I got lucky, or whatever the case may be, and now I'm making, say, $25 an hour. So 25 times 40 hours a week times 52 equals 52,000 divided by 12. So that is 4,333. Now my debt to income ratio is 38%. I can buy that all day long. All right. So you can see how numbers in a job can change things. So let's say I was making $20 an hour. Same thing. $20 an hour times 40 hours a week times 52 weeks in the year is 41,600 divided by 12. So that's 3,466. 3,466. All right. So now I'm at 47%. I can still buy this house. I might be able to do it conventional, but I can definitely do it FHA, I would say, depending on what the credit score is. Okay, so that's how your debt to income ratio is built real fast. The only other way to do it, let's take us back down to that $15 an hour job. And what we'll do is see what we can actually afford. All right, so that'd be $2,600 a month. All right, and now our debt to income ratio here is way too high. On that note, let's talk about that. So your top and your bottom, you don't want this to be in the 40% range. That's high. Basically, what this is saying is that with just your car payment, or with just your mortgage payment, you already have a pretty high debt to income ratio. The highest that you can go FHA is about 55%. Yeah, you can go a little bit higher, but you don't want to play. There's a difference between what you can do and what you should do, and what you'll get an approval for. All right, but just think of it in those terms. All right, and then the highest on a conventional loan, on this bottom, is going to be really, you're looking 43 to 45%. You can get an approval up to 49% if you have a certain, like a really high credit score and maybe some assets. It happens. Okay, but as a general rule, if you're looking 43 to 45% on the bottom end for conventional. Now, you would still want to run it if it's up to 49% if they got a high credit score, but it's just a general rule of thumb. So if I want to drop this down into, let's say, a target of 50%, I just start Playing with numbers. 125. Make this 3.5% down. Now I'm 57%. So now I'm going to drop it down to 100 because I can kind of bracket this. 3.5%. So that puts me around 51%. So I know I have a shot at this. All right. So then what I would do is I would get all the pertinent information, run the application, and I would see, can I get an approval if I run this through Fannie Mae's website, making $2,600 a month at $100,000 with 3.5% down. That's not bad. It's probably doable if the credit score is good and if they have some of their own assets. That's more about that on another video. But this is how your debt to income ratio would look and how a loan officer can actually figure out how much house you can afford. Now the question is that payment going to be okay? So that's another way to look at this is how much of a payment can you afford? And then, we can make an adjustment here. It might be like $90. So this is a way to take a look at everything. Now, debt to income ratio. When we add in this, which is a total of 575, plus this, and divide it by the 2,600, it's saying that that's taking up 50% of your available income. And remember, this is before taxes. So what you actually have in your hand might be a little bit less. So this is pretty generous. This is how you figure out your debt to income ratio. Now, the funny thing about this is I often see where people who make $10 or $15 an hour, they want to go after, larger homes. And the people who make, $30, $40, dollars an hour, or let's say that you made, I don't know, let's just say that you made $80,000 a year. So that's super simple. It's just 80,000 divided by 12. So then you're looking at about 6,667,000. Drops the debt to income ratio way down. All right. So just playing with numbers isn't very difficult for a loan officer to figure out what you can do. But you have to understand that is one of the primary reasons that we have to pull in your credit, because we have to know what is your debt. Have to know. And do you know how many people forget what their debt is? They forget all kinds of debt. So you can't just say, oh, I'm good. It doesn't work that way, because then you could get an approval, and nobody should ever give you approval, but they could give you approval and thinking that you're good, and you're not even close. As I've mentioned before, I had somebody that forgot that they own 20 square blocks down in Florida. 20 square blocks. How do you forget something like that? But it happens. Or co-signed on a loan. That happens all the time. Car loans. Yeah, I'm co-signed for my mom. I'm co-signed for my brother. Well, if you're co-signed, that means that their debt is your debt, and that adds in there. So if you co-sign for your brother's loan at $400 a month, and you're making $2,600 a month, well, now you're at 66 and you don't qualify. Right. The third way that you can reduce your debt to income ratio is, of course, to pay off debt. So if we didn't have that car payment, take that out. Let's say that you were able to pay off that ring. Now your debt to income ratio drops to 45%. So when you have like a large car payment, probably not going to be something you can pay off, but like that $150 payment that we just got rid of, if you only have like $300-400, let's say you only have four payments left or something, and you have that amount in the bank, you have the assets available to pay it off. That's another good way to reduce your debt to income ratio. So 3 ways. So you can either make more money, lower the cost of the house, or reduce your debt. All right. So hopefully this visual helps you out and understand that the top is just this divided by how much you make a month, and the bottom is the combination of your debt and your house payment divided by how much you make a month. All right, I know that was a little bit heavy on the just static visual there, and all my mouse is moving around as I'm babbling, but hopefully you can now see how it is actually built, and a good visualization, seeing exactly what we see when we build your loan will help you understand just how important it is to give us the numbers, let us pull the credit in, and calculate the income properly so we can figure out what your debt to income ratio actually is. All right. Hopefully this was useful to you. If it was, please subscribe to my channel. Hit that bell so you know when more videos are coming. And remember, it's all for one and one for all.